We are very pleased to have with us Ms. Usha Thorat, ex-Deputy Governor, Reserve Bank of India and current Chairperson of SEBI Mutual Fund Advisory Committee. Over the last 50 years, she's had a ringside view of all the epochal changes that happened in the Indian financial system, and she'll be sharing the insights that she has gleaned over this period with all of us in this interview.
Yeah, if you think about it, I joined Reserve Bank in 1972, and the reform started in 1991.
Yeah.
And that means I had 19 years of experience before the 1991 crisis and 19 years after, because I retired in 2010.
Okay.
So my 38 years is exactly divided in these two periods. How do I really capture the financial system of the time that I was there, say between 1972 and 1991? It was 1969, you'll recall, was the year of nationalization.
Yes.
So the largest banks, 85% of the banking assets were actually taken under state control. And 69, so 72, I had just joined at a time when the full rollout of the impact of nationalization was happening. So essentially, the entire period was a state-dominated financial system, state-dominated monetary policy, state-dominated debt management policies. So it was a period, the only way I can really describe this period is if you say on the eve of liberalization, when we had the balance of payments crisis in 1991, out of every 100 rupees of funds raised by banks, they had to put 68.5 in CRR and SLR. 68.5 rupees in CRR and SLR. And the remaining was what? Some 32 rupees. Out of that, 50% went for 40%, that is of that thing. So 50% went for priority sectors and food credit.
Okay.
So what was left was some 15% for other, what one calls so-called commercial credit.
Okay.
And if you can't believe it today, but if those days the interest rates for, say, government borrowing was, say, 7 to 8 or maximum 9%, and the corporate, top quality corporate, would have had to pay 15 to 16% at least.
Okay.
And normal businesses would pay 23, 24% interest rates.
Phew.
So completely the growth, the system in the private sector was starved of credit. It was really what you mean by, I mean, they call it financial repression, but it's a completely administered interest rates, fixed exchange rates, controls over credit, micro regulation over every aspect of banking. The real thing that happened at that time was branch expansion. It happened in a massive sort of a way, and it all was rural and semi-urban areas. So this was a time when the whole thing was the lead bank scheme was there. We had the concept of lead banks, lead district officers. It was all developmental. Small scale industry, agriculture, small businesses, exports. These were the sectors that were really being encouraged. It was we can't even imagine, those of you who were, really not on the picture at that time. So that was the scenario. Now the crisis of 1991 had many causes. And they were all related to macroeconomic stability, because we had fiscal deficit was too high, inflation was rampant, efficiency growth, especially in the banking system, accounting systems, recognized interest which was not earned, the entire losses of the system was camouflaged. There was no idea of productivity, profitability, efficiency. None of those things were important. So all in all, we had at the time of 1991 a very, we don't even know what the truth in the banking system was. We also know that it was very state dominated, and everything was administered and controlled. So when 1991 happened, the crisis immediately was a balance of payments crisis. We hardly had reserves to cover 11 days of imports. And in 1992, I was posted to that department which was managing the exchange rate.
Okay.
So I arrived in the Department of External Investments and Operations on the day the liberalized exchange rate management system, what was called LERMS, was introduced. And after about 5 years in that department, I moved to the debt markets and debt management department. So another 5 years. So 10, 12 years between, say, 1991 and 2002, essentially, in an area where we were doing things for the first time, actually uncharted territory. Everything had to be learned. So it was a very exciting period. Number of reforms took place at that time. We moved from a fixed exchange rate system to a market determined exchange rate system. We learned how to intervene in the exchange rate markets. We learned how to monitor foreign exchange flows. We learned how we moved away from that Soviet rupee ruble arrangement and all the bilateral arrangements. It was a switchover. Every exchange control was slowly dismantled. We started liberalizing capital flows. Foreign direct equity was liberalized. Foreign institutional investments were liberalized. Huge flows started. We moved on to current account convertibility. Then we started realizing that we had too much of reserves. Too much of foreign exchange coming in. So we didn't want the rupee to unduly appreciate. So then naturally we realized that buying dollars in the market, we were injecting liquidity, which would have impact on inflation. So all those problems, early days of intervention, sterilization, market stabilization scheme, which was introduced at that point of time, all those things, one just had to think on your feet and go ahead. And mind you, simultaneously we had stuff like the Pokhran crisis, sanctions, how to deal with the sudden stops in the foreign flows, and how to deal with the kind of situations that we faced. So it was it was like walking on it's a drama almost every second day. So that was the period, and the very important developments took place in the debt markets. Government borrowing became market determined. State government started doing auctioning. And so at that time, the government securities market, just like in the stock market, which and that was, of course, changes came much before. Here you only issued at 100 rupees. So reissuance of government securities, creating fungibility in government debt, creating a market for government securities, bringing in market infrastructure institutions like Clearing Corporation of India Limited, with which I was very closely involved, setting it up, seeing that it worked, and seeing that the kind of requisite environment was provided for price discovery to happen and markets to become deeper and liquid, including introduction of derivatives markets. So these were all the kind of changes that happened on the market side. On the banking regulation side, there was more competition by the introduction of foreign banks. So that was already happening when I was in the markets department. Okay. Simultaneously, other developments were happening, Narasimhan Committee 1 and 2, and all the developments that followed from that, which meant more competition, more role for foreign banks, more private sector banks. Almost all the new private sector banks, as we called them those days, they all came into existence. Some died. Then I got into supervision and regulation. So I had to deal with a number of mortalities and mergers at that time.
The DFIs faded away, maybe.
Yeah, DFIs also we did away with DFIs. But yeah, that switchover from IDBI to IDBI Bank and ICICI to ICICI Bank, yeah. But again, I was not in the supervision department. When I came into the supervision department, we had the things like Bank of Punjab, Centurion Bank, Ganesh Bank of Kurudwad, and even there was an episode of Ratnakar Bank, and then we had Bank of Rajasthan.
Okay.
So there was the Madhavpura crisis, which led to a whole shake-up in the urban cooperative banking system. So I was involved there too, in the urban cooperative banks. So this was a very, very exciting period, and a number of changes took place. I think all for the better, but certainly we had, we had quite a few learning mistakes, and we did make mistakes, but that was all part of our learning.
Okay. The establishment of SEBI as an autonomous regulator in 1992 was probably one of the most important regulation, the key changes that happened as part of the national economic policy. But at that time also we had this very famous Harshad Mehta scam in 1992 that brought out the nexus between the bankers and the brokers. And we saw how the weaknesses in the banking system kind of percolated into the stock market. And this has been seen even after that in other scams as well. I think you are one of the persons best placed to explain to all of us how this works out. Maybe.
Yeah, very interesting question. What we refer to as the stock market scam of 1992, it actually was a scam in the government securities markets. That was because the Reserve Bank's public debt office, which actually had dematerialized government securities known as the SGL in the public debt office. Every account there was known as an SGL account, subsidiary general ledger account. That is what the expansion is. There was, and that was the time of the early time when auctions were happening. So there was, the trading in the markets was just beginning in the government securities market. There were no proper contract notes. There were no confirmations between counterparties. Bank receipts were issued against so-called holding of government securities in the public debt office, but they were non-existent. There was no backing for those bank receipts. So that bank receipts became a clean form of loans against which money was given by banks. So that was exploited by Harshad Mehta and the back office in State Bank of India, which really created the opportunity to borrow huge funds ostensibly against government receipts, government securities with bank receipts which were fake and fake stamp paper, and raise crores of funding which triggered selected stock movements which were later on came to be known as Harshad Mehta stocks, and they triggered the upward movement in those stock prices, and then naturally his entry and exit could alter the ratios. You move it out when it's very high and then trigger a drop and then create more borrowing and then again fund others. So this was the scam. This was a scam which was created because of the kind of system that existed in the public debt office of Reserve Bank of India. So, and the banking system which full advantage of the loopholes coming out of those fake receipts and fake bank receipts. So the changes that came about were obviously, one had to bring in all kinds of regulations over dealing in security market transactions. That is, the banking system had to be put in place, all kinds of things like confirmations, very simple things, but it didn't exist. Then in the debt office, one had to bring in all this delivery versus payment, and for every single government security transfer, we had to get these forms filled up. Until midnight, the settlement would go on. And that was the time when the Clearing Corporation of India was also set up. So one arrived at net settlement. So the changes that took place in the government securities market at that time were driven by an emergency-like situation which exposed the entire system. So we call it a stock market scam. And interestingly, the Ketan Parekh scam, which happened, which was also called a stock market scam, because and then we used to talk about Ketan Parekh stocks. 2002, I think that was, if I'm not mistaken. Madhavpura happened at that time. And that was coming out of, again, a systems failure of the payment system, of the clearing system. So kite flying could happen between today and tomorrow morning. And then you could jack up the prices and, create. But of course, it was not as widespread as the other one, but certainly create its own havoc, especially in the cooperative banking system. So all the reforms in the cooperative banking system came after that scam. So I think the setting up of the National Stock Exchange and the urgency to set it up as a movement towards screen-based trading and slowly getting rid of Badla, all these changes started happening partly driven by what we had experienced in the stock market scam.
So you have worked with the markets department of RBI. So at that time, what were some of the interactions that you had with SEBI? during that time?
See, starting with the foreign exchange department, we had to, when we say we were managing the exchange rate, it was also that we had to monitor flows. So one of the biggest factors which was affecting the day-to-day movement of the exchange rate was the FII flows. And that was all stock market flows. So naturally, monitoring the stock markets and seeing how these foreign exchange flows were affecting the the exchange markets. They were actually for the stock market, but they were affecting the exchange markets.
Yeah.
So whenever there was a problem, it was happening because of outflows of FIIs. Today, the FIIs don't dominate the foreign exchange markets to the extent that they used to those days.
Yeah.
So we used to constantly interact with these FIIs, who also wanted the views not only on the markets, exchange rates, because they had to be sure they get dollar returns, and they also wanted to be more aware of the macroeconomic developments which would affect the individual companies. So they were constantly seeking out us, and we were seeking them out because we want to understand their psychology of bringing money into the forex market. So there was this active interest in ensuring there was an open dialogue without really, you're disclosing anything. But that was a period when one eye really sort of had to. And also any triggering of a problem, then we had to be in touch with NSE, then NSCCL, and so CDSL. So we had to deal with SEBI officers also, so that at that point of time you could either increase the margins or trigger some things which would stabilize the foreign exchange markets, because we were concerned with that. So that was the kind of interaction. The other area where we did have a good bit of interaction was when the repo we introduced. See, the ready forward was a very famous word used in the stock market, Harshad Mehta scam, which was a sell now and buy forward. So that actually became a borrowing and a lending of government securities, but fictitious government securities. Okay. So those were all done through what were called ready forward transactions. So ready forward was banned after that. And then the Securities Contract Regulation Act, that was, so when we had to reintroduce repos for purposes of monetary policy and allowing a money market instrument to get growing in the market, we had to interact. Naturally, it involved Securities Contract Regulation Act, where SEBI was the juice. So there was a lot of to's and fro's between SEBI and us on the repo and government securities. At that time itself, the repo and corporate bonds discussion had started, with SEBI. The other area where we had a lot of interaction was in the private placement of corporate debt and commercial paper. So a lot of almost the entire 99% of the market was really a private placed market, and with hardly any disclosure. So through the banking system, we sort of had to make sure that the banks only subscribe to those corporate paper where there was certain minimum disclosure requirements and certain minimum, the transparency. So SEBI also, we worked together with SEBI on that whole private placement structure. It didn't completely solve the problem, but certainly it was there. I was also a member of the Patil committee, which went into the development of the corporate bond market. So that was another area of interaction. When I took charge of supervision, we evolved this framework of financial conglomerates. That is, whether in the financial conglomerates like, say, State Bank or ICICI or HDFC, there were insurance companies, there were banking companies, there were non-banking companies, there were securities companies, investment banks and mutual funds also. So both general insurance and so there was a need for ensuring that this entire conglomerate was looked at, so that the interdealings between that were at arm's length, and various other aspects of if there was a problem in one, how would it spill over into the bank, for example. Obviously, we were concerned about that. So that financial conglomerate approach involved a kind of a joint inspection also of these conglomerates. When SEBI, IRDA, we would take it up, and then that framework was brought into place. The earlier MSDC, there was a high-level committee on capital markets which used to meet, which became that was a forerunner of the FSDC, because after the global crisis, it was the called the FSDC. But that was also another area where one had interactions with SEBI.
So you've been involved with chiseling the frameworks for almost all aspects of investment, from bonds to insurance to stock markets, everywhere. So it's very interesting, ma'am. So let's move on to there have been a lot of global financial crises over the last 3 decades or so. We had the Asian financial crisis and the global financial crisis of 2008. During these periods, we have seen that our Indian stock market and the financial system also has been relatively more resilient compared to other markets and so on. This was maybe partially due to the way the RBI and the SEBI have regulated the markets, the financial markets. So, are there any learnings for other regulators from the way our regulators navigated these crises?
I'm not sure we can give the entire credit to the relative resilience of the Indian economy and the Indian markets due to the regulators.
Okay.
I'm not entirely sure. But suffice it to say that the macroeconomic policies and the step-by-step movement towards greater capital account convertibility, and also the kind of prudential regulations introductions, were to prepare the country for eventual more opener capital account. And that was definitely a part of the policy of the government, of the regulators, both the monetary policy and the supervision. So I think it's true, the framework in which we were getting the real economy and growth into the picture, because you can completely open a country a capital account, which like countries like Indonesia did, and you can have huge capital flows coming in to fuel growth. And you can, but they also makes that country much more vulnerable. So that way we were much more insulated as a matter of policy. So, and that I think was one of the reasons why the Indian economy did not have was not that much affected by the global crisis through the channel of financial flows. But there were other channels through which the economies did get affected during the times of those crises, and that was the trade flow and the growth. So, and the global finance to a certain extent. So, for example, we never allowed those very exotic derivatives.
Exactly.
Partly because we felt that the system it allowed a leverage which we could not afford, because the markets would then become too volatile. And also, it also was because of most of the banking was still in the public sector, and one did not feel very confident that we had the ability and the skills to be able to manage these exotic derivatives, which people, if they didn't understand, then they certainly would have, you could have problems. So, to that extent, and to the extent of increasing risk weights on capital for certain selected sectors like real estate sector and loans against shares and retail lending, which happened in the year 2007, 2006, 2008. That also did help the economy when, when things altered and, interest rates went up and there was a problem. Banks and the real sector suffered, which meant that bad loans and non-performing assets started mounting. At that time, banks had some cushion to be able to fall back upon, because those cushions were built up in good times when there was a boom in the credit. So to that extent, yes, RBI can take the credit. And but then I would say that overall, the reason why we were more resilient was because of the way that the capital accounts and the overall macroeconomic management with the fiscal responsibility being introduced, those things, and some of the financial market.
Yes, so you have been associated with both, you have been largely associated with the banking regulator, and also you have seen the stock market regulation. So philosophically speaking, how do you see the mandates of the RBI and the SEBI? Do they converge at some point? Are they different?
Yes, both are regulators, both are financial sector regulators, And there's been a lot of debate, as you know, whether it should all be under one head, unified regulator like they had in UK before the crisis. So I would say the mandates are quite different. If you take away the role of RBI as a central bank, as a manager of money, then let's keep that role separate. I'm just talking about the mandate of the Reserve Bank, which flows from the Banking Regulation Act, is really to protect the safety of depositors' funds or protect the interest of the depositors. Because banks are in a way special. They are organizations. Banks, or when I say banks, the word banks, I also include any non-banking financial company which is able to take public funds. Public funds could be through deposits, it could be through CPs or bond issuances directly, but they are actually accepting public funds. And they are under the RBI regulation, non-banking financial. Banks take public funds without limit. Probably the only thing that limits them is the capital requirement, the CRAR. Otherwise, there's no restriction to the leverage that banks can do. So they accept public funds and they lend. So funds are given by public in trust on the bank. And the bank is taking the risk on the borrower. And these funds are serviced at a committed fixed interest rates. Whatever funds are raised by banks are committed to be serviced at the fixed interest rates. And you don't expect any capital loss either. Otherwise, the bank, there would be no confidence in banks. So banks are a creature very different from security markets, stock market intermediaries, or security markets intermediaries like, say, mutual funds, or any other intermediary who's a pass-through, who is a intermediary to help investors take the risk on the person who's raising money in the equity markets or in the debt markets, which is all traded on the stock markets. So that is the role of a mutual fund, say. It's a pass-through entity. So I think what is it then you want in such? You want investor protection. But nobody is guaranteeing returns to the investor or the safety of their money. What is being demanded is more transparency, more disclosure, in a communication in a manner investor can understand. Then you have the categories of informed investors and retail investors. So your job as a securities market regulator is to, one is ensure this disclosure and transparency. The other thing is to see that market trading and settlement and other practices are sound and efficient and safe. So that is very important and that role is that of the exchanges and the SEBI. So it's very important to know that markets can function with integrity, with efficiency, and with complete credibility. So that then the role of the custodian, the role of a depository, the role of because there should be no commingling of funds and the brokers. So those are the things why SEBI has to get more and more into. Those are aspects of investor protection. Whereas banking is, do you have enough capital to withstand loan losses? Do you have enough provisioning, which is the first line of first defense, and then you fall back on capital? How to make sure that depositors' funds are not eroded? So whenever, as a banking regulator, we intervened, it was really to see that depositors' funds should not be a target. So immediate first thing when you find a bank falling in its capital ratio is ask them to bring in more capital. Because that is how you safeguard the depositors' funds. So whenever mergers took place, everything, our concern was depositors' interest. Then only we started dealing with systemic interest. That was because of interconnectedness and so many other factors which had contagion in the markets. But originally, it's just the depositors' funds. So now you can see it's a very, very different role. And you cannot expect, and it's not fair to expect also a securities market intermediary to feel the same. So I'm just making this point because very often sometimes we feel people who invest in mutual funds, they should be as well protected as a bank depositor.
Yeah.
It's a very different cup of tea.
Hmm.
There are no capital requirements of the kind you have for banks. So I think that is the reason I'm laboring this point.
It's very well explained, ma'am. Yeah. So let's move on to the corporate bond market in India. So in India, it's not as developed as the bond markets in some of the emerging economies or other advanced economies also. So what are the reforms that have been done over the years and what more needs to be done in your opinion?
This is like a question which is as old as the hills.
I know.
From 1997, ever since I entered the debt markets, we've been talking about development of corporate bond market. And I've been part of every kind of discussion that has been there. One of the early things that we used to say is that reason I would say is because I know I might be blaming this for everything, but the fiscal deficit being the size what it is, the primary issuance of government debt and the continued SLR requirements actually in a way create a captive market for government debt. I wouldn't say that captive because SLR has steadily come down. And under the new post-global crisis regime, you have LCR and you have a lot of other liquidity requirements, which people have realized is very important for banking companies. So there is when the primary issuance is very high, then that is what we call the net borrowing figure of the government of India and the state governments. That becomes very high, then it's actually eating into the corporate market for the very primary issuance. So that I would say is a factor which has always been there, it continues to be there. Nevertheless, I would say that the issuance of corporate debt has actually grown quite a bit. So if you say the corporate bond market has not developed, what are we really saying? We are saying there's not that much liquidity in the corporate bond markets. The primary issuances are there, but maybe not like what makes the liquidity in the markets. There is a fungibility. Every stock looks alike, but every bond issued by a company doesn't look alike with another bond. Maturity is different, interest rate is different, its features are different. It's got various optionality. Each one is different. So that way there's no fungibility. And fungibility was a very important thing when we developed the government securities market. To the extent that we said, let's have strips which could combine the interest payments on various government debts which were falling due on the same day and independently traded. So you wanted to improve the fungibility in these markets. So that has also been a problem in the corporate bond market. If you had, say, a top class issuer coming again and again at the same time of the year for issuing the same thing, and he can issue it in more or less the similar maturities and create strips, then maybe the fungibility will be better and people can actually have much more liquidity. So liquidity has been always a problem in the corporate bond markets, and it's not only in India. I can tell you that. The advanced countries, it's not as if the secondary market trading in the corporate bond market is that high. There have been all kinds of working groups and committees which have gone into this. And one realizes that reason is also because in the corporate debt markets, the issuers and buyers are wholesale investors. A retail investor would rarely go and, enter into the secondary market for corporate bonds. My primary market, yes, I'll be happy to, you'll be happy to. We can take tax-free bonds, other bonds, or whatever it is. But in the retail market, it's not something like the stock market. So I'm saying these two markets you cannot compare. By nature, it is like this. But what is it that we worry about? And that directly relates to the period that I have also been chair of the Mutual Funds Advisory Committee. That is when 2020 happened, for example. Then what happened? Markets just dried up. And this has happened earlier also. In the global crisis, the same problem happened. Whatever people were, the mutual funds which were holding the NBFC paper found that on the date of maturity, they could not repay. So there was a need for liquidity to be provided so that they could have some breathing time. So special facility was given by Reserve Bank at that time, which went on for quite a long time for the mutual fund industry, but obviously through special purpose vehicle and also through the banking system, not directly. So that is what you find, because even AAA rated paper at the time when markets seize up like this, and taper tantrums also I think happen. I wasn't there at that time, but this becomes a problem, and that is a problem mutual funds face. So the developments over the last few years in terms of the efforts by SEBI have been to make sure that the mutual funds, especially the open-ended funds, have sufficient liquidity, and the debt funds particularly, so that there is when there is a time, then you don't have to, you have some very liquid assets which you can draw upon. So I think that has been when we talk about why this corporate, because we get panicked by thoughts of, so the two other very important reforms which has been introduced is, one is a backstop facility, and the other one is repo and corporate bonds, the clearing system for corporate bonds.
Okay.
So I think that trading platform plus the clearing and settlement thing, if it works well, it's not easy, I can tell you, because again, rating and pricing is different. Similarly rated bonds can have different market value. So you have to be able to know how to apply haircuts. In a repo and corporate bond, you can't do it for a single bond. Then for every bond, you'll have to, of course, you will be arriving at a margin for every bonds, depending on its liquidity. Or say a state government bond. I mean, these are things which one realizes liquidity is low, then it's very difficult to margin requirements and the kind of the requirements for what is essentially for a repo market. It's very difficult. But that is the effort that has been done in the recent period, which Finance Minister had recently inaugurated. So I think the efforts and to improve risk management systems have also a better disclosure of the risk of the portfolio. So the riskometer improvements.
Okay.
So these have been the kind of efforts that are being taken, and skin in the game and alignment of interest of the managers and the unit holders.
Okay. So talking about the Indian mutual fund industry, it's been really growing very fast, especially since the COVID. So what are some of the opportunities and the challenges that is before the industry as of now?
Yeah, that's right. That is what one has to see. So it has been growing, no doubt. It's been growing at a rate which is much more than the insurance sector or the banking sector. And yet the penetration is limited. I don't think it's even 10% of savings. So there is a huge opportunity in terms of greater penetration, because mutual funds are ideal investment vehicles for a retail investor. And I think once the retail investor is educated enough to understand that mutual funds, an SBI mutual fund is not putting money in SBI. It is you taking the risk on the underlying securities that fund is holding. And if that risk and return are disclosed, then is where he begins to really, or he or she begins to make an informed investment. But it's not as easy to understand as a bank deposit. So naturally, most of retail public will prefer to, go for a product they understand easier. But mutual funds have now taken on, and like you're rightly to say, firstly, the growth itself has been triggered to a certain extent by the liquidity that has been injected into the system, and the fact that mutual funds have also, got direct plans and ways in which they have marketed, which has really encouraged people. And when they're sitting at home and thinking of what they're doing in their savings, particularly, SIPs have become so popular amongst the retail investors. So they have seen that people have actually made money. Of course, initially the market was really down, and that was like in the dumps in March 20. And then there has been only, markets have gone higher. So people have actually had an opportunity to get more earnings than they would in the other financial, and therefore they have been attracted, and that itself has attracted more interest. So it has grown on itself, and it's been a very good growth, I would say, in the last 3 years. There's no doubt about that. At the same time, we've also had some unfortunate episodes. But the most important thing which affected the system was really the absence of liquidity when you need it, when the mutual funds needed it. So I think that is where SEBI has also acted on, and they've also acted on the other measures. So I think for the few going forward, my thought is that it's an ideal investment vehicle for a retail investor. But should institutional investors really be allowed to invest in mutual funds?
Okay.
I'm just raising this question, or at least have funds separately for retail investors, because the entry and exit of institutional investors does affect the NAV, and we saw that happening. Of course, then we brought in swing pricing and all that, and that was also part of the changes that were done. But it does, you do get a feeling that retail investors are always the last to enter and last to, leave, and they kind of sometimes are just left holding baby. So I think there is a need to look at that. There is a need to look at plain vanilla products. I would really prefer exchange traded products for the retail investors, which is not complicated, which has got so many hidden things which one doesn't even understand. And what is the risk on each of those securities? You can't be taking a call. You're just putting your faith in that fund manager's name and your earlier experience and some track record, which you get. So I think we need a product which is simple, plain, vanilla, exchange traded with minimum fees, which is very widespread sold for investor who will definitely make money on his investments. But the trouble is with the kind of multiplication of options, you just don't know how to go about your choices as a retail investor. So I would visualize that as one of the things that I think the Indian mutual fund industry has to see. The other thing is, of course, I've been talking about this, is also the role of the trustee and the role of the sponsor. See, do we really continue to need the support of a sponsor for mutual funds? Because they have come of age, they are also independently listed. So the asset management company is still definitely dominated. It's a sponsor dominated system. And the trustee company or the trustee firm has got the fiduciary responsibility. But the authority and the ability to independently raise money is not there. So in a way, the relationship between the trustee and the sponsor or the asset management company does it leave complete independence to the trustee company, and therefore the need for really having good trustees can actually exercise that kind of a fiduciary responsibility. So I think there's been again a lot of effort SEBI has gone into to really look at the role of the trustee, role and responsibility of the trustee, role and responsibility of the sponsor, so that it's very clear who are you really holding responsible for what, and it doesn't fall between the two. So that is one area I think which is happening, but I would say maybe much more. The other area where I see the future is that one needs to have measures to identify conflicts of interest and also to be able to know how to deal with it. Because when the fund manager is acting, he has to at all times be incentivized to act in the interest of the investor and not in the interest of an issuer or some debt bond issuer or equity issuer where there could be conflicts of interest. So I think that's another very important aspect. Finally, I think the effectiveness of the regulation is the effectiveness of the enforcement. And if the regulators' decisions have to look at the principle and the philosophy underlying it rather than the rule or the law. And I think that becomes a bit of a problem. So one has to be able to see whether the investor protection, what has been done is in the interest of investor protection. And that is what SEBI is for. So I feel that is also something that the enforcement has to be definitely.
Okay, ma'am. So final question. A lot of young women look up to you as inspiration, those who want to make it big in the financial services industry itself. So, what would you like to tell them? What is advice that you'd like to share with them?
Be a total professional. That is what. Learn. All the time you have to be learning. You have to be absorbing, you have to learn from others. There's never such a time that you know it all. Never. Humble. Be humble. Be courageous. State your mind. I love the SEBI young team here. They all say exactly what they need to in the open MFACs also. So I think it's important. I think it's important to have diversity of opinion. It's important to be able to hear, listen to the markets. Remember cost of regulation. All the time be mindful of it. Don't bring in a regulation. I'm talking actually to SEBI. I'm not talking to the financial sector. But from the regulated point of view, I've said understand this whole regulation is in the interest of the market. So don't try to circumvent and find loopholes and try to find out of it. Compliance should be a philosophy. And say that regulations are intended for the stability and safety of markets and for orderly market conditions to grow. So that is what I would probably.
Very important last words. Thank you so much, ma'am, for joining us and sharing your insights.
Thank you so much.